I don't know about you, but I don't like spending all day in front of my trading screen. I want to have the time to do other activities I enjoy while having some trades in the background. So I'm revealing a profitable 1-hour trading strategy, and I will share how I find the leading signals, how I know right at the beginning of the day if the market is worth trading or not, and all of this by spending just 30 minutes in the morning. Before we begin, if you want to show support, please leave a like to help us with YouTube algorithm and turn on the bell so you don't miss when new videos are released. The speed of the markets on lower time frames represents a big problem for many traders. All the trading decisions you make will have to be done much faster. One solution to this problem is trading the 1-hour time frame. The 1-hour chart offers flexibility, there's considerably less noise, and it also generates enough trades so you have lots of decent chances of making money. This strategy involves finding trending days based on the central pivot range, a leading indicator, and taking trades around safe areas in the direction of the main trend using simple price action. By the end of this video, you'll know right at the beginning of the day if you are going to trade your market, and you'll also know the direction you'll follow. If I have to name my favorite indicator, well, it's the pivot points. Pivots are nothing but support and resistance based on the high-low close of the previous day, and offers you a framework to trade on. By plotting pivot points on your chart, it will show you boundaries where price is likely to face support or resistance. Unlike lagging indicators, pivots don't change as you change your time frame. Once you plot them on your chart at the market opening, they remain there until market closes. And one more aspect, pivots are being used by big players. I came to know about the central pivot range concept after reading The Logical Trader by Mark Fisher. The CPR is nothing but a range of 3 lines, one above and one below the central pivot point of the day. The fundamental idea behind this indicator is that the particular day's trading range captures everything about the market sentiment. So this range can be used to predict the price movement of the following days. How to read price action using the central pivot range. When the CPR makes higher highs, meaning the CPR is higher than the previous day, that indicates that the particular market is in an uptrend. When the CPR makes lower lows, meaning the CPR is lower compared to the previous day, this indicates that the market is in a downtrend. As long as the price is above the CPR, it's generally known as a bullish day. And as long as the price is trading below the CPR, we are in a bearish day. Of course, this doesn't mean if you see the price trading above the CPR, you'll go and buy it. CPR is just a guideline, and I will show you later how to filter and find the best signals. The wider the central pivot range, the more difficult for the price to break the area. This basically means that wider central pivot ranges are more powerful than a narrow with CPR. Have a look at this chart. This was a wide CPR day, and when price retraced to the area, it found support and was unable to go below it. And look at what happened when the CPR was narrow. The price broke on both sides of the area, hunting stop orders, and no clear trend during the day, just sideways price movement and lots of consolidation. So, if the CPR is too narrow, it's unlikely the CPR will offer a solid support or resistance area. Whenever the CPR is too narrow, I don't pay much importance if the price comes near it, because it can easily pierce it and break it. So remember, narrow CPR doesn't offer much support or resistance. Also, when the central pivot range is wider, often but not always, such days are range days, where price moves from one range to the other throughout the day. Look at this example. We have a strong move upward, so the next day the CPR was quite wide. We had a range day around this area, and remember the previous rule. A wide range means that it's more difficult for the price to break the area. Another observation is that a narrow central pivot range can lead to a big trending day, and a wide central pivot range can lead to a quiet and range-bound day. In this example, you can see a very narrow range day, which leads to a huge move during the day. Observe how the price was trending in one direction, with lots of momentum. And of course, after such a strong trending day, the next day was a wide range CPR, with sideways price action. This is an efficient way to analyze price, quite different from the classic price action techniques. There's another high probability setup, and that is the fresh central pivot range. If on any given day, price didn't touch its CPR, it will be considered as fresh CPR for the next coming 2 or 3 days. Here's an example. The price made an aggressive move downward, and the next day, price action didn't touch its CPR, so that was a fresh CPR, an important area to keep an eye on for the next several days. Sometimes, during the trading day, you'll see no candlesticks inside the CPR, but only 1 or 2 wicks entering inside the CPR. This is also a fresh CPR, and still a very powerful support or resistance area. And here's an interesting fact I found out after my backtesting. Price respects a fresh CPR at the opening of the session, compared to mid or late afternoon. So if the previous day was a fresh CPR, and today at the opening, price approaches the area, then the fresh CPR has a high chance to work as a strong support or resistance. If price approaches the previous day fresh CPR after the middle of the trading session, then the CPR isn't likely to work as a strong support or resistance, and price can easily break it. Here's an example. We have a fresh CPR on the chart, and on the next day, the market opened below the fresh CPR, touched it, and the area acted as resistance, and price immediately reversed. So a fresh CPR works as a strong support or resistance at the opening, and less powerful during the second part of the trading day. Plotting the CPR on your chart can give you a great edge in your trading. CPR is also known as the heartbeat of the market, where price is likely to change its direction most of the time. CPR is a powerful support and resistance area, so it's not a good idea to go short when the price is above the CPR, because it will act as a support area. And it's not a good idea to go long when the price is below the CPR, because it will act as a resistance area. The idea of the strategy is to buy and sell the waves of a trend. One of the best ways to buy and sell pullbacks in a trend is to play the bounces of the central pivot range, which is the method many professionals use. Essentially, each pullback to the pivot range is a buying opportunity within an uptrend and a selling opportunity in a downtrend. How do I define a trend using the CPR? Very simple. If the current day CPR is higher than the previous one, we have a short-term uptrend. We look for long entries above the CPR. If the current day CPR is lower than the previous one, we have a short-term downtrend. We look for short entries below the CPR. This is an important condition in our strategy. So at the beginning of the day, the first step you need to take is to analyze the position of the CPR relative to the previous day. If it's higher, you know that during the day you'll be searching for long entries. If it's lower, you know that you want to short the market. If the CPR is wide, you know that the price will most likely find support or resistance at the CPR, but you will also be prepared for ranging conditions. If the CPR is narrow, you can have a strong trending day, but at the same time, the CPR may not offer much support or resistance. Using the 1 hour time frame, you remove the noise on the lower time frames. Just by looking at the chart at the beginning of the trading day, you'll know what to expect. This is how trading should be, planned and organized. Here are several techniques I use to filter signals and to trade only the high probability ones. The first one is the classic trendline breakout, which is one of the most effective strategies if traded correctly. Trend lines connect consecutive higher lows in an uptrend and consecutive lower highs in a downtrend. The idea is to use the momentum of a trendline breakout to find trades around the CPR area. The strategy here is very simple. If the price breaks a downward trendline, the CPR is higher compared to the previous day, and the price is testing the central pivot range from the upper side and found support, then you should look for long positions. Conversely, if the price breaks an upward trend line, the CPR is lower compared to the previous day, and the price is testing the central pivot range from the lower side and found resistance, then you should look for short positions. Here's the Euro-Yen. We had a sustained downtrend, a 3-day uptrend, and a trendline breakout. As the price broke this previous swing, it found resistance at the lower central pivot range. The rejection came in the form of a pin bar. As the central pivot range was also lower than the previous one, the conditions were met for a short position. Also, this is a wide range CPR, and we already had some previous price action returning to the zone. We know that during wide CPRs, we could witness some ranges, so a short trade right below the CPR was also in line with this, because the price already moved throughout the day. Stop loss goes above the CPR or above the central pivot point, being a wide range, and you target the next big swing, or a minimum 1.5 reward compared to your risk. We have an uptrend with a 4-day downtrend correction, 4 consecutive CPR days. Here we have the first up central pivot range and the double bottom around this level. The next day was also an up CPR day, with the price breaking above this trend line. This time, the price managed to reach the middle level of the range, the central pivot point, found support, and continued its uptrend. Always look for candlestick formations to reveal rejection. In this case, it was a pin bar forming inside the CPR. We also had confluence with this swing high breakout, which became support, long above the CPR, with a stop loss either below the pin bar or below the middle CPR line, and you target the next swing high, right here. The second strategy involves the Ichimoku cloud, but will only use the conversion line or the Tenkan-sen. The conversion line will help you with the short-term price momentum and also signals an area of minor support or resistance. If the market price is above the conversion line, this indicates a short-term upward momentum, and you would want to concentrate on buying signals. If the price is below conversion line, this reveals a short-term downward momentum, and you would want to search for selling opportunities. You also need to pay attention to the slope of the line. An increasing conversion line, meaning an upward slope, indicates an upward trend. A decreasing conversion line, meaning a downward slope, indicates a downward trend. The idea is to find zones with the central pivot range and the conversion line close together, areas of confluence. So if the CPR is higher compared to the previous day, the price is testing the central pivot range from the upper side and stays above the conversion line. You look for long entries. If the CPR is lower compared to the previous day, the price is testing the central pivot range from the lower side and stays below the conversion line. You look for short entries. Here's a long entry. We had an upward CPR day, higher than the previous day, so we look for long trades. The CPR is wide, so we expect strong support. We also have the conversion line offering support. And look what happened when the price entered the zone. It touched the conversion line, formed a pin bar, and reversed. This strategy offers a lower stop loss. You could place it below the conversion line or below the pin bar, rejecting the area. You don't need to place it all the way below the CPR area. And here's a short Tesla trade. We found a lower CPR day. Price is below the conversion line, so downward momentum. At the opening of the session, price entered the central pivot range and touched to the pip both the upper level and the conversion line, and immediately moved in the opposite direction, forming yet another pin bar. The pin bars are my go-to signals, perfect for this strategy. As there is clearly bearish pressure, we took a short trade right after the pin bar. Stop loss above the conversion line, which is also above the pin bar in the CPR, targeting the next swing. If and when price moves above the conversion line, you need to be careful and close at least a part of your position, because momentum is shifting to the other side. As always, if you got any value from this and learned something new, drop a like to help us with YouTube algorithm, and make sure you click the bell icon to stay in touch when new videos are released. Until next time.